Hey guys, my name's Eric. Thank you guys for joining the session. So we're just going to go over some risk management ideas, strategies, as well as kind of going through the psychology of every trade. Whenever you have like a large sum of money or just money in general, I think it's very important to understand how much you're allocating towards any type of trade you're making. So, for example, let's say you have like a 10K account, and you only played options, right? 10K was your life savings. You only played options. You buy, say, like these a position in AMD costs $200 a contract. You buy one and it expires like 5 days, right? Then you buy another one, right? And then this is just more of like a hyperbolic example, but the idea of what I'm trying to get across is like whenever you're trading options is a risky asset to be trading in the first place. And so ideally, I think there should be more emphasis on how much are you going to lose, how much are you willing to lose, how much are you willing to risk, and what's your exit plan. I think those three should be your primary focus with any trade, right? So it's more so you're prepared in case the trade goes against you, right? And it's okay to be wrong on a trade. No one's gonna have like 100% accuracy rate, and so understanding when to exit out of a trade and having a point of invalidation is very important. And then kind of goes into charting, looking at the levels. Again, like with options, very easy to blow your account up, especially if you're new. 10% max, I would say, is short-term trades. Going back to the 10K example, if you have 10K, 10% of 10K is $1,000. So the idea of starting small, and I know like, if you put more money in, you could possibly make more, but it's just the reality of, are you willing to lose all that money? Like, what happens if, say the market is in your favor? What are you going to do? Right. And so, like today, for example, if you had 10% portfolio in options and say like 90% was just cash, you would have had a field day today, in my opinion. But again, right, this is accordingly based on experience, your own risk tolerance. But again, in terms of managing your money, there's many ways to hedge. You can buy, say you have calls, you buy SPY puts, QQ puts, do like a 1-to-1 ratio to hedge. You could be cash, reduce market exposure. I think like the more you trade, the more, especially like nowadays, during these turbulent times, it's always a better idea to limit your market exposure, because like again, February is a relatively, at least towards the end of February, is notoriously known for chop and sell off.